break. We have now joining us Jyoti Gupta, research analyst at Nirmal Bang. Jyoti, our reporter is indicating that the budget may or the proposal may be to increase defense spending by 20 to 25% in FY27. How do you see that for the entire sector?
Good morning, and thank you for having me on the show. So, 20 to 25%, I think it's a bit high, but yeah, the outlook looks to remain expansionary with the FY26 allocations of around 6.8 trillion, which is around 9.5%. We expect forming the base for an expected increase of 10 to 15%. 25% would be a great number. So, and as spending trends edge towards around 2% of the GDP amid heightened geopolitical risk. In fact, capital outlay, which is roughly around 1.8 trillion, we expect this to become 2.1 to 2.3 trillion. So potentially lifting its share to 30%, which is currently at around 26%. So it's structurally very positive for the industry. And in fact, the recent rally also that we saw yesterday reflects fundamental strength emanating from government spending, policy reforms, earnings beats. Because while third quarter could be a mixed bag, but I think fourth quarter would be very, very strong for the entire industry and anticipated budget support that we are seeing right now. So the long-term outlook definitely remains supportive, but near-term valuations are stretched, and therefore selective profit booking or tactical entry on dips may be prudent.
If you look at the budget spending of last year or the budget estimate of last year, there will be a revised estimate which will be much higher than that because of Operation Sindoor which came into being. And then if you're looking and if you are estimating 10 to 15%, that would be on a higher base which will be there. So in reality, from a budget estimate to of FY26 to budget estimate of FY27, the growth may be around 20%, right?
Yes, could be around. But then, we have to see the major challenges which are currently there in the industry as well. Um, uh, you know, what is important is we need to see the working capital for the companies, the private players, the stretched working capital, then execution would be the key. And of course, the technology developments, especially R&D in terms of AI, in defense and supersonic technology. So we need a lot of research and development in the. So I think my focus would be to see more of allocation in terms of research and development rather than we do have enough order books, and the key would be earnings going forward emanating from execution.
Uh, Jyoti, hi, morning. How do you look at this venture? I know you track HAL. How do you look at this venture into civil aviation? What's your sense with regard to that? And does it at all change anything in terms of estimates for you?
I don't see HAL. HAL does do some civil aviation part, but I don't see it venturing significantly like 10 to 20% moving into civil aviation as of now. I think we have a very critical platform, Tejas, which needs to be executed. Um, so yeah, first of all, I want to see HAL delivering 7 aircrafts by fourth quarter of FY26 and maybe another 12, at least 12 in FY27 before it actually ventures into civil aviation.
Sure, point taken. With regard to BEL, again, the delivery was extremely strong. The likes of a Garden Reach also, the numbers were extremely strong, Jyoti. Do you believe that that kind of, growth clip can sustain individually? I mean, there are some segments of the community, analyst community, which seems to suggest Garden Reach has peaked, but BEL can sustain. Give us your take.
BL definitely I'm very positive for the next 3, 4. In fact, for the next 5 years, I see the order book is not peaking at any point of time, and BL has sustained that revenue trajectory, and I think that 15% guidance that the company gives, I think they're going to surpass the guidance in FY26 and going forward in the subsequent years as well. Bell is on the execution side. I think Bell is one company which is aligning with standards and living up to our expectations. But as far as Garden Reach is concerned, I believe the trajectory that they are currently now, they should be able to sustain it. But any surprises going forward, possibly difficult to see at this point of time.
Jyoti, how do you see the execution capabilities of for many of the companies? Orders are not an issue any longer. I mean, everyone is sitting on 3 to 5 years of order book. From an execution point of view, do you see more capex now coming in from many of the defense companies so that they can fasten the execution of these order books?
Uh, See, execution, one needs to understand that the pace of execution right now has already picked up. What needs to happen is sustainability, and that should be a function of their working capital requirements. If and they should get enough support from the government on that side. Scaling up for some companies, despite good order books, could be a challenge going forward. So, I mean, I think. Uh, the large ones will continue to do well. The companies which have already broken their, have that threshold of scaling up should do well going forward. But I think smaller players will face some sort of challenges in the next couple of quarters.
Uh,
Jyoti, my
how,
question to you also is with respect to the margins many of the PSU defense makers are sitting on. We saw the BL numbers and 29% margin. They've been guiding a conservative 27%. But what is heartening to see is that the moment they increase the indigenization content in their entire execution, the margins increase. Do you see that as a trend now for many of the defense PSUs?
Hey, first of all, we need to understand that any defense company with long duration order visibility, deep indigenization, exposure to capital intensive platforms, strong margins, and capital and credible export optionality is a preferred stock. Now, why? Else you should avoid any players which are dependent on single programs or low tech commoditized supply. Now, within that, yes, if you increase indigenization, your margins should expand. And for Bell, I believe the guidance that they've given of 27% is conservative, and that should improve. But I think that should happen by end of FY27, maybe from FY28. While I feel that they will, they will surprise my expectation of FY28. Bell should see a margin expansions of by 1%, maybe in the next financial year itself.
okay, thank you so much for that, Jyoti, for coming in and speaking with us. We'll let you go on that note. Of course, defense